So, as we've been reporting, on Wednesday, the Federal Reserve raised rates to 1.75%, bringing US rates on par with South Korea's. And with more Fed hikes signaled for July and for the remainder of this year, perhaps into next year as well, it seems the Bank of Korea is going to have no choice but to make some big rate moves of its own before too long. Eun-jin with this report.
The U.S. Federal Reserve took a giant step this week by raising its key interest rates by 0.75 percentage points to 1.75%, its highest increase in 28 years. Now the Bank of Korea has had no choice but to follow suit and implement its own big step interest rate hike. In order to minimize impact on the South Korean economy, South Korea's interest rates need to stay in tandem with interest rates in the U.S. In a scenario where U.S. interest rates were higher than Korea's, the result could be a massive flow of capital out of Korea's economy. But the Fed has also announced that benchmark rates will rise up to 3.4% by the end of the year, consequently making it more likely for South Korea to also increase its rates. There are 4 more Federal Open Market Committee meetings scheduled this year in July, September, November, and December. It is highly expected that another giant step may be taken in July, raising interest rates another 0.75 percentage points. Fears loom over what the BOK may decide over the 4 Monetary Policy Board meetings it has remaining this year, and whether it will take an unprecedented big step of a 0.5 percentage point interest rate increase.
We need to understand how it affects the foreign exchange market and the bond market rather than the interest rate gap itself.
Some experts and analysts suggest that a gradual increase in increments of 0.25 percentage points would be better than a big step hike.
A benchmark interest rate hike is inevitable, but a jump in interest rates will only worsen the challenges to the economy. We need a gradual increase.
As much as a sudden jump in interest rates is expected to shock the market, it will also impact the country's economy. This comes amid global efforts to recover from the COVID-19 pandemic, as well as the prolonged war between Russia and Ukraine. Further policy coordination is expected between the Ministry of Finance and the central bank to counter high inflation and the nation's household debt issues at next month's meeting. Eun-jin, Arirang News.